This is Ian Saison of Bloomberg News in Manila. With me today is Dr. Marc Faber, editor and publisher of the Gloom, Boom and Doom report. Dr. Faber, thank you for allowing this interview.
Yes, my pleasure.
Dr. Faber, global stocks have taken a beating since the U.S. approved the $700 billion bailout package, and Europe has taken steps to spend hundreds of billions of euros of its own to fix its financial system. More than $5 trillion in market value has been wiped out already. How worried are you, or how worried should one be with these developments?
Well, I think that if you go back a couple of years, the markets kind of peaked out in March 2000, and at that time we had a bubble that was essentially concentrated not in stocks, but in the TMT sector, technology, media, telecommunications. So it was a very concentrated bubble, and then it burst, and then, as you know, the Nasdaq went down 70%, and across the world, technology shares and telecommunication companies' share were weak. And then the Fed began to pursue an ultra-expansionary policy on top of the expansionary policy they had pursued actually already in the 1990s. And it cut the Fed fund rate from 6.5% on January 3rd, 2001 to 1.75% by year-end 2001 and 1% in 2003, and left it at 1% until June 2004. And then they started to increase interest rates in baby steps, quarter of a point at a time, until the Fed fund rate reached 5.25% in August 2006. Then they left it at 5.25% until September 2007 and slashed it down to 2% in January 2008. What the artificially low interest rates did in the period 2001 to 2000 essentially and 5 is that it led to extremely strong credit growth in the United States. And I think that in that respect the Federal Reserve made a mistake in allowing credit growth to expand at such a rate. And this credit growth led to the unusual constellation in the world, which is unprecedented, that you had bubbles everywhere. Real estate bubbles in every country around the world. You had stock market bubbles in every country around the world. And you had commodities prices going through the roof, oil price from $10 in 1998 to $150 earlier this year. And you had art prices going up everywhere. Any kind of worthless collectible went up in price, and even bond prices rallied. And this is unusual because if you look at the history of bubbles, even under a gold standard where money supply is kept relatively limited, you can have bubbles, but they were always concentrated in one sector of the economy or in one region of the world. Or you take, say, the Japanese bubble in '89. There wasn't a bubble at that time in America or in Europe or in emerging economies. The bubble was concentrated in Japan and in Taiwan. Or you take the Nasdaq bubble in year 2000, it was concentrated, as I said, in the TMT sector, but we didn't have a bubble in commodity prices, we didn't have a bubble in emerging markets, we didn't have a bubble in bond prices and so forth. So the fact that this excessive credit growth led to bubbles everywhere should have made the Federal Reserve and the regulators somewhat concerned. Now, starting in 2006, home prices in the US stopped going up, and then they began to decline. We had the first failures of subprime lenders at the end of 2006, but the regulators perceived that to be just an isolated case, and then the subprime lenders, the crisis spread and more subprime lenders went bust, in the first half of 2007, but again, the policymakers, Mr. Paulson and Mr. Bernanke, thought that it would be contained and would have no impact on the rest of the economy and so forth. And then in the second half of 2007, other financial firms also got under selling pressure, the banks and the brokers and so forth, and then this accelerated in 2008. But I'd like to really stress that the asset bubble began to break essentially sometimes in 2006 with condo prices and home prices in the US no longer rising. And since we had this universal asset bubble where everything went up, my concern is obviously that asset classes one after the other will also come down, like if you have a row of dominoes and stones and then you push down one, then all of them will fall. And what we've seen is the first decline in the housing market, then some financial institutions go bust, then the decline in equity prices since last October. We will now soon be 12 months into a stock market decline. Yeah. That has brought down many markets by more than 50% from the highs. And we have a collapse in lower quality credits, anything that is not a treasury. The yield hasn't gone down, but it's gone up. And recently, since July, commodity prices have collapsed, in some cases also by 50%. So what we really have is, from a period 2001 to 2007 of accelerating credit growth, suddenly credit growth has collapsed. This is, I've never seen such a decline in credit growth as we've had over the last 6 to 9 months. This is unprecedented. And just yesterday they reported that consumer credit collapsed in September. This is the biggest collapse since 1943. So when you have an economy like the US that was addicted to credit growth because the credit growth allowed home prices to go up, it then allowed people to take additional loans, refinance their homes and go and spend it. When this credit growth slows down, it leads to a process of deleveraging throughout the entire society. Not only deleveraging by the individual who now can't extract money anymore from his home, has to repay loans, and if he can't repay, he defaults, and if he defaults, someone else will default, and so forth. And you have deleveraging among financial institutions because, again, through changes in the regulation, in particular also the removal of the Glass-Steagall Acts in 1998 or 1999, I forgot when it was, you had essentially these banking giants mixing with investment banks, and then some regulations were changed under the influence of Wall Street, where investment banks, Wall Street firms could leverage themselves, with the end result that in 2007 some brokerage firms had, for each dollar in capital, $30 in assets. Well, I wouldn't want to run a business with a leverage of 30 to 1. For me, I feel uncomfortable if I have any debts at all. I like to run a business purely on cash, but certainly not 30 to 1. And you have to ask yourself, today, the financial markets, through financial, in quotation mark, innovation, have become unbelievably complex. I'm a financial man, and I spend time only on economics and financial issues, but I'm not familiar with all the products that are floating around, nor would I want to be, because some of these new structured products, they have prospectuses of a few hundred pages. I used to claim that the longer a research report was going to be on a company or an industry, the more that industry or company stock would collapse. Because what is good is simple to explain. And what is bad needs a long explanation why and so forth and so on.